Hi everyone, and welcome to this presentation on how to pocket 1.9 million for every 10,000 in your retirement account. If you're looking to accelerate your retirement account, I'm going to reveal to you how you can pocket as much as 1.9 million for every 10,000 in your account through four specific secrets that I'm going to reveal today. Now, most investors would be thrilled with a 10% annual return every year. 10% compounded over 20 years, though, only turns $10,000 into just over $67,000. That is a far cry from turning $10,000 into $1.9 million. But it's not as far away as many believe. The power of compounding returns is actually far greater than what most investors understand. Because of this, little attention is paid to investment strategies that can add another 2%, 5%, or even 10% to their annual returns. They do not realize the multiplying effect of just adding a little bit to that percentage return. Because to increase your overall return from turning 10,000 into 67,000 to turning that same 10,000 into 1.9 million seems like a complete impossibility. And so investors turn to high risk, home run type trades, thinking that this is the only way to really achieve wealth. But the good news is that pocketing 1.9 million for every 10,000 in your account is not as far away as you think. And in this video, what I'm going to do is I'm going to show you a rock solid, proven strategy that has the ability to do exactly that. And what does it take to pocket 1.9 million for every $10,000 in your account? Well, if 10% annually compounds 10,000 into 67,000 in 20 years, by adding 2%, just 2% of that annually, it compounds 10,000 into over 96,000 in 20 years. In other words, a 2% increase in the overall return, average annual return, increases your overall return by 30%. A 2% annual increase increases your overall return by 30%. If you up that to 15% annually, your 10,000 now compounds into over 163,000 in just 20 years. So a 5% increase over a 20-year period increases the overall return by 144%. So you can kind of see where this is going. 20% annually compounds 10,000 into over 383,000. And so now we've gone from a 10% annual return to a 20% annual return, but our overall return after 20 years is 472% increased by just that doubling of the annual percentage. And so you can see the process here. But a 30% annual return compounds 10,000 into over 1.9 million in 20 years. In other words, a 20% additional return increases the overall profits after 20 years by 2,735%. That is the power of adding to your annual rate of return and compounding it. Now, if there's anything you need to take away from this, it's that every percentage point matters. So what I'm going to do is I'm going to show you a method that makes it very possible, very realistic to hit this 30%. But even if it doesn't, every additional percentage point that you can add is going to add up into an enormous amount over the long haul. So our goal is to average 30% annually, because that is what compounds into 1.9 million in 20 years. And that's for every 10,000. And I'll get to what happens if you add more to that here in a minute. Nevertheless, this is a very unrealistic goal with the buy and hold. In fact, it's might near impossible with the buy and hold. You're just not going to buy and hold a stock or a group of stocks or an index for 20 years and expect a 30% annual return. It's just not going to happen. In fact, if you had invested 10,000 in the S&P 500 in January in January of 2000, so that's going back 23 years, more than 23 years, That same 10,000 only grows to 46,722. The annual rate of return is at 6.72%. That's not going to get us anywhere near where we need to be. We need to do better than this. We need to do astronomically better than this. So the buy and hold approach, the long-term investment approach, it just isn't going to cut it if you want to really build wealth. And that's where the super portfolio rotation comes in. The portfolio rotation strategy is a powerful approach to achieving significantly above average returns with less risk. So in 2000, just to kind of give you an idea of how this works, in 2000, major stock indexes were up about 20%. However, in the S&P 500, the entirety of that 20% could be attributed to just 25 different stocks. So out of 500, 25 different stocks are what basically made up the 20% return that year. In other words, if you didn't have those 25 stocks and instead had some combination of the remaining 475 stocks in the index, you likely didn't come anywhere close to generating the 20% returns that year. And most years are very similar. The majority of the returns of an index are attributed to a small group of stocks. And that brings us to the first secret to achieving above average returns, and that is to have a group of stocks, a group of rock solid, proven stocks that have consistently outperformed the S&P 500 year in and year out. So rather than try and hit the long shot home run in some pharmaceutical company where you're going to lose all your money in a matter of months, we're going to invest in math. That's what we're going to invest in. We will invest in rock solid, proven stocks and let the compounding create our wealth. Now, I want to just take a second here. This is the first part of it. A buy and hold is not going to do it. Even within a group of rock solid, proven stocks, it's not going to reach our goals. So we're not going to buy and hold here, but we're going to start with this group of stocks. We're going to start with a very solid group of stocks, and then we're going to add the strategy to it. So what I'm going to do is I'm going to show you 10 stocks. I'm just going to reveal to you 10 stocks from a pool of over 150 stocks that we have painstakingly researched and settled on as our super portfolio group of stocks. This is the core. This is where we start from. There's about 150 stocks that we have narrowed down to be in this very elite group of stocks. And I'm going to reveal to you 10 of them. And these 10 are the bottom part of the 150. I'm not going to reveal to you the best stocks. I'm going to reveal the bottom part of the stocks. But this is the foundation from which we will build on to achieve the 30% annual returns. This group of stocks, again, it's 10 out of 150. It's at the bottom of the group. It's not at the top. I'll show you that here in a second. But I'm just going to start showing you these stocks and why they are better than the overall index market. So here is the first one that we're going to look at. ATR. ATR, if you would have invested 10,000 back in 2000, the year 2000, today it would be worth $138,287. So that's an annual rate of return of 11.71%. Now, remember this. If we don't achieve 30% annual returns with the SPR program, every percentage point matters. And so if we're starting with a stock that has an annual rate of return of 11.7571%, we're already adding to our percentage point, right? So this one, not the best in the world, but it's really solid. It does more than 3 times what the S&P returned during that same time period. Here's another one, EQT, and that again, very similar rate of return, 11.51%, turns 10,000 into 132,000 in the same time period. Here's one of my favorites, not because it has a massive return, but because of its reliability. So there are 2 aspects there are more than 2, but 2 very important aspects to characteristics to making our group of stocks. Number one, they have to have a solid return. Number two, they have to be consistent. And so this one is a steady Eddie, and everyone knows this one, Pepsi. Pepsi is a steady Eddie. And the annual rate of return here is at 9.78, so 10,000 would have turned into 91,000 after 23 years. Here's another really solid one, Bank of Canada, Royal Bank of Canada. And 10,000 would have turned that into 179,000 in 23 years. So this one is not 11.5%, but 12.9%. So it's 1.5% more. And look at how much more, over $50,000 more than the first two stocks that we looked at that were only 11.1%. So the math is going to be the same on all of these. Here's another one, Universal Health Realty Income Trust, UHT. That turns 10,000 into 142,000. Again, 11.84%. So there's a lot of stocks here that are just solid returning stocks consistently year after year. Here's Abbott Laboratories. In fact, I have a signal in ABT right now, I believe. Oh, nope, that's not that one. It's a different one that starts with an A. Anyway, 10,000 turns into 113,000 during that same time period. The annual rate of return 10.78%. Here's another one, HRL. I love this one. I love this one because what we can do with it. HRL turned 10,000 into 115,000 over that same time period. The annual rate of return, again, this is just the buy and hold, 10.88%. HRL, I'm in right now. And the expected probability of return on this one is topping like 86%. So we're actually in this right now. It's a really good opportunity. So that's one of them in there. Here's another one, SO Company. Again, one of my favorites, not because it outperforms. It's not one of the best performing. It is a solid one at 13.8%. And again, this is in the bottom half of our 150 stocks. But this has gone back to 1980. It has consistently, 70% of the time, on the buy and hold, year over year, you would have made money at an average annual rate of 13.8%. Actually, it's slightly more than that over the long term. So since 2000, it's ever so slightly underperformed. From 14% to 13.8% over the long term. So incredibly consistent. And this one is a solid play. Again, here's the last one that I'm going to show you. FISV. Some of these you've probably never heard of. Again, 13.2% turns 10,000 into 190,000. You get the idea of the type of stocks. If this is in the bottom part of our stocks, what's in the top part of our stocks? Well, I'm not going to reveal those to you, but I'm going to show you the numbers. And these are not the best. I'll show you the best. It'll blow your mind. Here's one, 558,000. That's an 18.48% return. Here's a 19% return annual average. Turns 10,000 into 630,000. Here's 730,000, 608,000, 488,000, 471,000. Look at that. How many of these are 10, 15, even 20 times better performing than a buy and hold in the S&P? And these are buy and hold stocks. Listen, if you just had this group of stocks, it would be worth everything, because just investing in this group of stocks gives you a tremendous portfolio of diversified stocks with a really solid track record, proven track record. And so you get these. Here's one, 823,000. That's 20 times what the S&P returns, based on a 20% average annual return. Here's one at 1.3 million. 10,000 turned into $1.3 million. Average annual return of 26%. So that is an incredible return. 30 times what the S&P. Here's another one, 20%. Here's another one, 17%, 20%, almost 21% down here. 19%, 19%, 20%, and 21%. $1.04 million is what 10,000. So you can reach with 21%, you can reach $1 million in 20 years for every 10,000. We're going for 1.9%. None of these do it. None of these do it, right, with the buy and hold, but they get us a lot closer, right? So I'm going to show you one of the best stocks. Now, this is not going to repeat itself over the next 20 years. I want to be very clear about that. This stock will not repeat itself, but it is a solid stock, and there's no reason to believe that it's not going to be in the upper echelon, continue to be in the upper echelon of stocks. If 10,000 invested in this stock turns into 12 million, none of you would guess what this one it was. It's not Walmart, it's not Amazon, it's not Tesla. You wouldn't guess what this was. And a lot of these stocks, you're not going to guess what they are. So 12 million. This one gets there. It's at 35%. We're going for 30%, right? So this is about 23 years, a little over 23 years at 35%. Every percentage point counts. And we have the potential to exceed 35% returns with the SPR. And I'm going to show you that here in a second. But here's the last one I'm going to actually reveal to you like an extra one. This is one I'm in right now. And this one, if you were to buy and hold, turns 10,000 into 401,000. It's Starbucks. And this is at a 16.85% return. Well, what you're going to find is that you can take this trade alone, and based on the annualized return that we expect and have achieved with the SPR, to exceed 35% annual returns. All right, so annualize. I'm gonna use that one. I'm gonna say that one. So this one, I want to add one last thing. I mentioned this is all $10,000. Many of you have way more than $10,000 to invest, and you can get there with more than 10,000. You don't have to add a whole lot into your account to really do well by adding to the percentage points of your annualized returns. Here's 25,000. 25,000 invested in our top performing stock over the last 23 years turns 25,000 into 31 million, right? So we're talking about low numbers. You can invest $10,000 in the SPR, but if you put $25,000, you're looking at all that much more. And I'm going to cover that here a little more in a second. So 25,000 invested at 25% annual returns reaches 1.1 million in 17 years. That's how fast you can get to 1 million with a 25% annual return with a $25,000 account. And that's for every 25,000. So if you're looking at 100,000, you're looking at 4.4 million in 17 years. That's significant by being able to increase your annual percentage rate. Okay, now these stocks are not obvious. In fact, you wouldn't recognize most of them. You do recognize some of them, right? You recognize Starbucks, you recognize Pepsi. There are some in there, but you'd be surprised at what stocks didn't make the list. It's not obvious. Here's a few stocks that didn't make the list. Walmart. Walmart didn't even come close. Walmart's a horrible investment long term. Average annual rate is 5.59%. $36,000 is what 10,000 turns into. It underperformed the S&P. Here's another very popular one, Bank of America. Horrible long-term investment. Horrible. $22,000 is what 10,000 turns into. Here's one that also didn't make it, and you're gonna be like, what? Wait a minute. Tesla is not in our group, and why? Because it's too erratic. We need consistency. There's way too much risk in Tesla, but the average annual rate of return has been 51%. You can't dog on it too much, but it just hasn't been long enough. We can't go from starting with 2010 and really adequately judge the strength of the stock moving forward from this point on. Tesla probably will be just fine, but it didn't make it because the risks, it's just up and down and up and down and up and down. So that one didn't make it. Here's another one. Verizon Communications didn't make it. And then here, Ford Motor Company. I mean, the staple of America is a horrible long-term investment. Did not make the cut. So, our first step is to give you a solid probability of achieving extraordinary returns that compound in millions, is to start with a rock solid, proven group of stocks to invest in, and that's exactly what we've done. And that brings us to step two. The buy and hold, even in this elite group of stocks, is not going to get us to our goal. It will do far better than most conventional. In my opinion, it will do far better than most conventional investments, especially stock investments. But if we can just improve it just a little bit, we don't have to have the Holy Grail. We just need to improve it just a little bit. Improve the efficiency of these stocks just a little bit, and that's what brings in the timing. And I've been trading since 1987. I've seen everything, I've tested everything, I've traded everything under the sun. Suffice it to say, I've narrowed down what I believe to be four basic conditions. Four basic conditions that need to be present to give you the highest probability of yielding the most efficient return in any given stock. This is it's really simple. Obviously, I'm not going to reveal to you these four basic conditions, but I am going to show you what they can do. In short, I take the stocks that are in the super portfolio and I look for these four conditions to exist. If these four conditions exist, if they're true, if all four exist, then I buy. If just one ceases to exist, then I look to exit. As simple as that. So four conditions, if they are all true, I buy. If one of them turns to not true, then I look to exit. So what do these four conditions do? And I want to be very clear about this, okay? Because this is not the Holy Grail. We're just trying to improve it a little bit. All right, so here's ATR, the stock that I revealed to you earlier. A buy and hold 11.71%. 11.71% buy and hold, right? Annualized return. Well, what we do when these four conditions exist, when the SPR, the Super Portfolio Rotation, four conditions exist, the winning percentage on this stock goes from about 75% to 88%. And you'll notice this is based on a $1,000 investment, year over year, non-compounded. Okay, so non-compounded, it returns $95 for every 1,000 invested. That's a 9.5% return year over year. Okay, non-compounded. So if we then compound that, obviously that increases tremendously. Nevertheless, at that point, what we have here is we have something that is less than 11.71%, right? But here's what I want you to notice. Average trade length, 70 days. Now, this is trading days. It's not calendar days. So it's a little longer than 70 calendar days. Nevertheless, what that means is that this returns a 35.4% non-compounded annualized return. 35% annualized return because I'm not holding on to it for very long. In other words, here, 9.5%, 11.71%. I'm capturing about 80% of the profit potential, 80% of the profit potential in 25% of the time. All right, 85% of the profit potential and 25%. So I'm only holding on for 25% of the year. And I'm capturing 85% of the return. Okay, that's what is going to allow us to really compound. Here's another one, EQT. EQT, annual rate of 11.51%. This is the buy and hold, so you're always in. By changing to the only holding when the super portfolio rotation four conditions exist. Look at the profit. Again, this is based on a $1,000 investment year over year, non-compounded. 16%. 16%. Notice the time of length that we're holding, only 54 days. That's an 81% non-compounded annualized return. Holding on for just 22% of the year. So in this one, it goes from 11% to 16% in 22% of the time. You get the idea here. We are trying to isolate the time period, the conditions that promote the highest efficiency for holding this stock. So here's one again. Here's Starbucks annual rate buy and hold annual rate 16%. 16%. Okay, this is a steady Eddie. Starbucks is really a steady Eddie. It's hard. In fact, you're going to find that the four conditions exist in Starbucks most of the time, right? Most of the time, it's a buy and hold. And so we can't improve this one a whole lot, but we can improve it a little bit. So this is 16%, but by only holding with the four conditions, it jumps up to 22%. However, it does hold for quite a long while, about 75% of the year. But that comes to a 31% non-compounded annualized return. What's our goal? 30%. 30%. Right? So we are putting ourselves in a position to achieve that 30% annualized return through this simple process where we are isolating a solid group of stocks and isolating our hold time to only when these four conditions exist. Okay, now here's a sample group of SPR strategy stocks, and you'll notice the winning percentage is in blue, the annualized returns are in orange. So the winning percentage you can see here are 75% or above. In fact, we don't even put in a trade that does not have a winning percentage of 75%. So 75%, and then the annualized returns are almost always popping up at about 20% or more. And this is just a small sampling. It's not even the best. I'll show you something here in a minute. So we are consistently putting ourselves to achieve annual average annualized returns of upwards of 30% on average. Okay, so you can see that. That brings in the next very critical piece of this puzzle, the third secret to achieving above average returns, to compounding that into millions, is what I call rotation stacking. Rotation stacking. So it's the super portfolio rotation, and we're also stacking. Here's the concept. I'm going to give it to you in a very simple term. In January, we pick a stock in our group of SPR stocks that have the four conditions present. We hold it for 3 months. Hopefully, we gain 10%. We exit that one. We replace it with a new stock that just came on the board that where all four conditions exist. We hold that stock for 3 months. We gain hopefully 10%. We exit it. In July, we pick a new stock that came on the board with all four conditions. We hold it for 3 months, gain 10%, exit, repeat, rinse and repeat, right? Well, this process allows us to stack the returns, and we're not increasing our overall risk, right? We aren't increasing our overall risk because we're only holding one stock in this example at a time. Now, that's not the way we're going to do it. I'll get to that here in a second. But at the end of 1 year, what happens is this 10,000 grows into $14,641. Notice this is a 46% return, not a 40% return, a 46% return. So if you can do this, if you can do something like this, very similar to this, you're talking about 46% annualized returns that you can then compound, far exceeding our goal. And why is this 46%, not 40%? Because when we exit our stock in in April or in late March, we're then going to take that 10% that we just made and we're going to invest it in the next stock. So we're not investing just 10,000, we're investing 10,100. Or 10,000 11,000, 11,000 into the April pick. And then we're going to make 10% on that, and we're going to invest that entire time amount into the July, into the October. So you have intra-year compounding, and that's what gives you the extra 6.4%. And remember, every percentage point matters. So just the stacking alone, even if we can only average 3% every time. The stacking alone is going to add a couple of percentage points to this. All right. So 5 years at 46% doing this turns 10,000 into 67,000. In 10 years, it turns into 452,000. In 15 years, 3.4 million. And in 20 years, 10,000 grows into 20.48 million. So now we have a means to our goal of 30%. And it's by taking these solid group of stocks and rotation stacking. Uh, Implementing a rotation stacking process. Now, it may not, it's not going to go 10%, 10%, 10%, right? We're going to be losses. There are going to be losses. There's going to be inconsistencies, right? So let's say this is how it works out. January, on average, you make 7%, and then April stock, you lose 3%, and then July's, you make 14, and October's, you make 12. Well, at the end of the year, that grows to 13,251. That's a 32% annualized return. We're there, even throwing a loss into the mix, and erratic returns on these others, right? So um, we reach our goal by this, and in fact, we exceed our goal by having a 32.5% return. Look, instead of 1.9 million, it's 2.79 million after 20 years. Now, again, 100,000. If you to put 100,000 in this scenario, 100,000 grows into 408,000 in 5 years, and then 100,000 grows into 27.9 million in 20 years if you can achieve a 32.5% annualized return through this process. This is nothing to sneeze at by any long shot of the imagination. This is why everyone should consider starting this right now. And again, this is for illustrative purposes only. For illustrative purposes only. This is just to give you an idea of the concept and the power of the growth if we can reach and maybe even exceed our goal. Okay? We don't want to pick one stock though and just put 100% of our capital on that one stock for each rotation, because if that one stock really tanks, then we're going to be in trouble, right? So clearly we have to diversify. That's why we have a group of about 150 stellar stocks that we rotate through out the entire year. And some stocks we're in for 6 months. One stock I'm going to show you we're in for a week, and it has a massive return. So this can be more efficient or less efficient depending on that particular stock and the performance of what's going on. All right, so obviously I'm not going to reveal the whole process. That would take quite a bit of time to teach you the four conditions. They are simple, but you have to have a certain understanding about them. Again, this is 33 years in the making. So what I am going to do is I'm going to show you how you can follow these trades. I'm going to give you my exact signals. I'm trading these. I trade these. I trade them exactly the way I give them to you. I also trade them a little differently myself, but I do trade them exactly the way I give them to you in one portfolio. I make a few alterations for my own testing in another. Nevertheless, if you want these exact signals, you can start with as little as 10,000 because you can trade one share, right? You can trade one share anymore, and you can sign up at a brokerage where there's no commission. So makes it really easy. Obviously, if you have more, you're going to want to try out more. I'll talk about that here in a second. But here's what you get with these signals. You get exact entry and exit instructions. These are weekly alerts that we provide. We give you a super portfolio rotation monthly newsletter, and we give you a quarterly super portfolio rotation recap webinar. So here's what one of the week's signals look like. And you can see here again, we are long HRL, so that was filled. We're long HRL, and you can see here the buy limit is 37. The number of shares is 20. The allocation is 1.5%. Now, you can go as high as 5% if you want, but because we rotate through so many, there's a chance that You may not be able to take all of the signals, but by only doing 1.5%, there's a chance that you're not going to actually ever be fully invested. So there's pros and cons with each. I discuss that more once you subscribe. Nevertheless, so this is based on a $50,000 portfolio. So I give you the number of shares based on a $50,000 portfolio. So if you have a $10,000 portfolio, you would just divide this by 5. So in HRL, you would buy 4 shares in a $10,000 portfolio. You're like, 4 shares, goodness. Well, you got to understand, we don't care how the return comes. We're just trying to achieve the 30% return, right? So because we have so many, right now I think I'm in a total of 25 stocks right now, I believe. So that's where we are, and things are about to pick up quite a bit. So let me show you this real quick. Here is just a sampling of closed trades this year. These are all trades closed between May 18th and July 12th, so just under 2 months. And you're like, oh, you probably cherry picked this. No, I didn't. Well, actually, I did, because I wanted to show you the group that have the 2 losses in them. So I wanted to show you that we do actually have losses. Between March and July, the super portfolio rotation just did unbelievably well because the overall broad market was also up. All right, so it's not going to be realistic. So I did want to show you some of the group where there were some losses in here, but you can see here the hold time 127 to 518, so about almost 5 months. 222 to 518, 4 months. 19 to 523, 315 to 62, so less than 3 months, right? So it all varies because we're going to hold as long as the 4 conditions are true, or unless if we hit a target. With that, solid group of trades here. Here's the same thing based on a 5% allocation. So this is a 1% allocation. What I want you to notice is that this was up 3.2%. The trades that closed out in a 2-month period up 3.2%, risking only 25% of the account. In other words, we were never with this group of stocks, we only had 25% of the account at risk, and we're up 3.2% in 2 months. That comes out to a 12% return, 12% return annualized. So if this were duplicated over the next 6 months, or excuse me, 18% return annualized. So if this were duplicated over the next 12 months, so this would be a 2-month period, so you multiply this by 6. So it's over 18%, almost 20%, risking only 25% of the account. Now, again, this is a solid return. This cannot be expected every 2 months with this small group of stocks, but it shows you what is possible. Here's where you're allocating 5%. You're talking about a 10.6% return, risking only 85% of the account in 2 months. Right? This is a 10.6. We closed out in 2 months, 10.6%. So if we can close out that every 2 months, which we're not going to, but if you can close that out every 2 months, you're talking about a 60% annualized return on an 85% risk. All right. Here is the annualized return for each individual trade. So annualized returns, same group. You can see here 94% annualized, 30% annualized, 37%. Here's the loss, 27% annualized based on the length of time that we held it. 120%, 128% annualized, 48, 37. Here's that one that we only held for a week because it hit our target that quickly. 518% annualized return. So we can turn around and use that profit and get into another stock, or maybe add another cost average on a stock that might be losing. So that is possible. Here's 61, 92. You get the idea. Most of these are at 30 or above, and that is what's going to allow us to stack these and achieve our goals. So with the monthly newsletter, we cover the open positions, we cover possible rotations for the upcoming month, and I list the stocks to you. And I give commentary, analysis, and general observations about the individual stocks, the entire sectors, the overall market in general, and anything that might be relative to the super portfolio rotation. During the quarterly live webinar recap, here's the big thing is I answer any and all questions that you might have. So we discuss the portfolio's performance. We look at the previous quarter stock rotations, the outlook for the following quarter. It's not a long call, but we do take the opportunity to answer any and all questions that you might have. Here is the pricing. This is introductory pricing. This is going to be this is my prediction, and I think it already is. I think it's the best stock letter out there, the best stock timing letter out there, the investment letter out there. And most of these are a lot more expensive than this. But here's the deal. This should be committed to for a long period of time. This is not based on the next 3-month performance or 2 months performance. This is based on long-term performance. So 12 months, $9.97. If you commit for 2 years, it's $14.97. So that's only $62 a month, committing for 2 years. And let me tell you this: that this just having the group of stocks, just having what stocks we're using is worth this amount. So having the timing and the signals along is just like a huge bonus. So the 2 years commitment is $14.97. But here's the kicker. If you go for 2 years, if you subscribe to 2 years, we're not going to keep charging you that for every 2 years. In fact, we're only going to charge you $297 a year thereafter for life, as long as you remain a subscriber. So if you get on for the 2 years, then the third year is $297, and every year thereafter, we only charge you $297. So if you're gaining access to this kind of information for only $62 a month to begin with for the first 2 years, and then it drops to $25 a month thereafter, I mean, this really becomes a no-brainer. So when you sign up for 12 months, if you only want to give it a 1-year try, $9.97, you'll still subscribe for the next year at $9.97, but thereafter we still give you a discount. It's just not as big of a discount. Or if you ever stop your subscription. So you're grandfathered in the $297 as long as you remain. If you drop out and then come back, it'll be $497 after that point. So that brings me to the fourth scenario, and that is, what if stocks crash? What if stocks crash? Right? There is no guarantee that the super portfolio rotation program is going to make money. Everybody knows that this is an investment. But what I do want to show you is that, for example, in 2008, when the S&P was down from high to low 38%, SO Company, which is one of my favorites, actually finished slightly higher. And our trade in SO, because we were only holding while the 4 conditions exist, was up 9.5% when the S&P was down 38%. That's not always like that. The same stock during the 2020 pandemic crash, the S&P was down 35% from high to low, while SO was actually down 40% from high to low. So in that scenario, SO actually underperformed the overall S&P 500 because it was in a sector that took a hit because of what the pandemic created, right? So SPR was long Southern Company at the time of that crash, and it was down 40%. However, another stock that we're in was down only 22% from high to low. But in 3 months, just 3 months after that low, it finished up from our entry point 34%. So this one did really well, but you don't have to worry about the ones that don't do well, because if you only have 1.5 to 2% allocation, it's not going to affect the portfolio very much, right? So very solid approach in diversifying through this as well. And overall, in all of our stocks, the net drawdown on the entire portfolio at the time from high to low was 21% during the pandemic drop. So the S&P was down 35%. Our portfolio was down 21%. So in other words, there is risk in a stock market crash. If the market crashes, if the market crashes, SPR will still lose money. I don't want to sit here and give you any idea that that's not the case. It absolutely will. However, we believe that the SPR is positioned to give the portfolio a high probability of outperforming the S&P even during a crash. So in other words, if the market is down 35%, SPR is only down 21%. That would be even less if you're not fully invested. Right? If every stock goes to zero and you can only lose 85% of your account, for example, if every single stock goes to zero, then you're not fully invested, which means that your loss is going to be even less. And a lot of times we're not fully invested and we're still achieving these stellar returns. However, there's still no guarantees that even this goal of outperforming the S&P during a crash will be achieved. There's no guarantees. That's really what brings me to the fourth piece of this approach, and that is a bonus webinar that I'm going to be giving you, how to hedge your super portfolio rotation account. I'm going to reveal to you how to maintain a full hedge on your entire account so that if stocks retrace or even crash, your risk exposure is minimal. Now, the hedge is going to cost you, the way that I do it, it costs you about 1.2% a year. So if you make 20% the first year and you had 1.2% in insurance, we'll call it that, then your overall return is going to be 18.2% or 18.8%, not 20%, right? However, if the markets crash, you might even make money the way that this hedge works. It's not guaranteed, but you might even make money. So that's going to any down year in stocks. Hopefully, the hedge will reduce that risk even more, and you're going to increase your overall average return. So during the pandemic crash, the hedge capped the drawdown of SPR performance to just over 6%. So it didn't completely hedge against the loss, but it did cap it at about 6%. So if you have any kind of stock portfolio whatsoever, you're going to want to watch this video, even if you don't get involved with the super portfolio rotation account. So every percentage point counts. That's what I want you to remember. Every percentage point counts. Maybe you have a college fund that you want to start for your kids, or maybe you want to start one for your grandkids. Maybe you only start with only $10,000. Or maybe you have $250,000 or $100,000 in your retirement account. You don't want to risk all of it in the SPR, so you only allocate $20,000 or $30,000 of your retirement account into this program. Whatever it is, I cannot imagine why someone who has a stock portfolio would not want to participate in this approach. And this is really what sets it apart. A $20,000 allocation in SPR, if we can achieve 25% annual returns. Okay, so we're certainly putting ourselves in that position to do so. But a 20,000% allocation grows to $1.7 million. Okay, it grows to $1.7 million. $100,000 conventional 7% annual return only grows into about $386,000 in 20 years. So 1.7 million in 20 years or 386,000 in 20 years. This is 1/5 of the investment risk in SPR potentially grows almost 5 times bigger than the conventional investment. 5 times bigger investment grows 1/5 of the amount of SPR, what the SPR potentially grows into. So 20,000 instead of 100,000 grows 5 times bigger than your 100,000 in the conventional investment. That's what I'm talking about with regard to efficiency and why everyone who is involved in the stock market should at least consider an allocation into the SPR. You cannot afford to not allocate something to SPR. And especially if you engage in actively hedging your against a black swan event. All right, so I think you have the information. I think you've probably decided whether this is going to be for you or not. Again, introductory pricing only. This is for a limited time, 12 months, $9.97. Go for the 2 years. If you're going to do it, you might as well commit for the 2 years. And that way you lock in your $297 for the 3rd year and thereafter. Again, limited time only. I hope you've enjoyed this presentation. I hope to also see you on the next quarterly update call. Everyone have a wonderful evening.